Be Wealthy and Smart, episode 1420.
Step into a world of wealth and financial freedom without budgets, boredom, or bosses on Be Wealthy and Smart. And now, here's your host, Linda P. Jones.
Welcome to Be Wealthy and Smart. I'm Linda P. Jones, America's Wealth Mentor, empowering women and men worldwide to financial freedom. On today's show, we're going to talk about some potential market-shaking events on the horizon. Now, it may or may not be causing a lot of volatility, but there are some things that are definitely going to potentially shake markets up. Now, already the sentiment for the market is in the greed range, as we've been on a 6-week winning streak. But markets recently started to pull back a few days ago as the Treasury yield rose higher. The 10-year Treasury yield broke above 4.25% last week. The dollar has also been headed higher, up 0.4% in its fourth straight positive week. With the S&P already being up a lofty 22% on the year, some things on the horizon that could cause market-shaking events are corporate results from the Magnificent Seven and the employment report, as well as the election being near. The S&P's price-to-earnings ratio based on earnings estimates for the next 12 months is at 21.8, which is near its highest level in 3 years. With equities at elevated valuations, that can make stocks vulnerable should any of the near-term market events fall short of expectations. 5 of the Magnificent Seven group of mega-cap companies that now account for 23% of the weight of the S&P 500 are reporting quarterly results next week. Google, parent of Alphabet, Microsoft, Meta, formerly Facebook, Apple, and Amazon. Any unexpected results from these large companies could result in swaying the markets. Peter Tooze, president of Chase Investment Counsel Corp., said, "People will be on pins and needles for most of the week. The market is expensive. Anytime you have an elevated market, the potential for a bigger downdraft exists if something disappointing happens." The Magnificent Seven stocks have an average price-to-earnings ratio of 35 times, which is way above the market average, but oftentimes companies that have stronger profit growth are awarded higher PEs, so it's not unusual to have high-growth companies have these kind of higher multiples. Bryant Conkrite, senior portfolio manager at Allspring Global Investments, said, "I see a handful of companies that deservedly have very high multiples, but if that reason for being deserved falters, then there's a lot of room below for those stocks to fall." I've talked in the past about how we are going to be at some point expecting these mega cap companies that have spent so much on artificial intelligence to start talking about benefits to their bottom line. That has yet to happen, and at some point there's going to be a reckoning where the market won't give them a pass on that, and we'll expect to see some results from their artificial intelligence investments. AI hyperscalers Microsoft, Amazon, Alphabet, and Meta are set to increase capital expenditures by 40% this year, while such CapEx spending for the rest of the S&P 500 companies are on pace to fall 1% in 2024, according to BofA Global Research. Next week is the busiest week of the third quarter reporting season overall, with over 150 companies in the S&P 500 posting results. Then, on November 1st, we're going to see the U.S. jobs report, and investors have been weighing whether a stronger than expected economy could lead to fewer interest rate cuts by the Federal Reserve than originally anticipated. Economists expect the employment report to show that the economy created 140,000 jobs in October, according to Reuters. The report could be messy in the wake of 2 significant storms, but the wages data will be important to watch, said Nanette Abuhoff-Jacobson, global investment strategist at Hartford Funds. She said, "If we saw an uptick in wages, that would be concerning. The bond market is already getting a whiff of possibly stronger growth than expected, possibly inflation rearing its ugly head again, and the possibility of the Fed not being able to ease as much as what's priced in." She's right, and we already saw Treasury yields climb to 3-month highs this week, reflecting expectations of a less dovish Fed perhaps, as well as possibly increased spending under the next president's term. And we've seen the volatility index, the VIX, edge up to around 19 after being below 15 last month, indicating more volatility ahead. I think we're going to see more volatility as we get closer to the election, and that's just something that we should expect. Traders are still expecting interest rates to decline by 0.25% in November, and there's a 97% chance of that now. So it looks like we'll be still getting an interest rate cut in November. The question is on the table about December. I think we're still going to get another 0.25% cut in December as well, but we'll see how that turns out, and I'll be reporting back to you to let you know. I want to make a special announcement about a documentary film coming up that I was interviewed in called XRP Unleashed. If you want more details about that, go to lindapjones.com/blog and read my blog post. If you haven't yet subscribed to Be Wealthy and Smart, hit the subscribe button and you'll be notified as soon as new podcasts are available. And all of my podcasts are on my website at lindapjones.com/podcasts. That's all for today. Until next time, live the good life and be wealthy and smart.
Thank you for listening to Be Wealthy and Smart with Linda P. Jones. Share the wealth and tell your family and friends about the show. Check out our website, blog, and social media for more riches at www.bewealthyandsmart.com.